Rob's child. Welcome everybody. I've decided that I want to do a video series covering security analysis. That's right. The same book that Warren Buffett and Michael Burry attribute all of their success to, and many other very successful investors. I want to go through this book, try to get all of the juice out of it that I can, and discuss its concepts, how they might apply to security analysis today. Few notes before I begin this series. First of all, I am in no way planning to do a series so long that it replaces this 830-page long book about security analysis. I hope that this information will suffice as a supplement and a gateway to discussing the ideas in the book and how they might relate to what's going on in the world today. Please like and subscribe and comment all your thoughts below. I want to hear everything that my watchers are listening, if I get any watchers, get any viewers. Second disclosure, nothing that I say on any of these videos is any kind of investment advice. So let's go straight into the book. This is Security Analysis, second edition, published in 1940, and supposedly it has all of the keys to unlocking how to analyze securities. By the way, this book and these videos assume that you understand the basic concepts between about what a bond is, what a stock is, what interest rates are, what yields are, and many other basic things about security analysis. If you have trouble understanding anything that is being discussed in the book or anything that I say, do some research on it. Use the internet. Use Investopedia. It's a great resource for that kind of thing. So, diving into the book. The first part of this book I'm going to cover is the introduction. So the introduction, interestingly, is titled Problems of Investment Policy. So it's a great way to start the book with a problem that needs to be solved. So the problem of investment policy, what is he referring to? He's referring to the idea that you can have one idea about how to value a security and use it for everything. Well, you can't, because you can have a company like Starbuck Carriers that had a 96% yield at one point, I think, and a company like Nvidia that has a 0.06% yield and a PE ratio of over 200 now. So, if your policy is a high yield, the value of your security is not necessarily going to reflect what you might think is normal. So, and there are many problems involving how we analyze securities. So the first part of this that I think is important to cover in this introduction is where low rates come from. We've been in a low rate environment since 1980. We've been going in a straight line down. If you take a look at the yield of the 30-year Treasury bond, just recently we kind of popped up out of that. I think it's going straight back down. But we are in the point is we're in a low rate environment right now, and he starts by discussing why that can be. Why can you have a low rate environment? Where does that come from? And I love how he explains it very basically. He says there's 3 reasons: too much capital, too much money, fiscal policy, government spending too much money, or slow business. And slow business can be for various reasons. Lacey Hunt is one of the most famous guys on this subject, who talks often about demographics and how that has led inflation, and then inflation has kind of led where rates can go. So you have the baby boomer generation, they're all buying houses, everything goes to the moon because everybody's spending so much money. The 30-year bond goes up to over 15%. I hope anyone that had money in 1980, well, probably not many people watching this video are in that category. Including myself, I was born after 1980. But 15% yield for 30 years guaranteed. Wow. But anyway, I digress. I'm going to try to digress as little as possible throughout this series. All right. So, yeah, where do low rates come from? I've thought about this many times before, but I love how he breaks it down into those 3 categories. You have too much money chasing too little yield, right? So, a 30-year bond, there's only so many bonds out there, and then there's so much money out there. And also with stocks, the stocks pay out a certain amount, and the more money people have, the more money people are spending on buying stocks, on buying bonds. They keep buying them and buying them and buying them. Well, that drives the price up, and when the price goes up and the yield stays the same in numerical value, then the yield goes down. And that's part of how rates work. Rates on the 30-year bond are highly affected by how much money is being spent on bonds, on all investments, really. And so, a low rate environment is largely the effect of too much capital, of too much money, And it's so funny that we're in post-COVID right now as of the recording of this video, about 3.5 years after it started. And the government, printed tons and tons of money, right? And they got inflation. And they were like, oh, it's just transitory because we know how this works. It's going to go straight back down. And instead, it kept going up. So we're like, oh, we're going to keep raising rates up. And, they're getting a little giddy about it, if anything, because it's not a good thing to have rates be stuck at 0. That's not a good sign. But did printing money fix the problem? People like Jeff Snyder, if you ever watch his videos, and Lacey Hunt and Stephen Van Meter, for example, they all agree that no, we haven't solved the problem. In fact, we've probably made it worse. You make more money. Where does it go? It went into stocks. Well, okay, stocks are worth more. Are they producing more yield? Kind of, maybe a little bit more profit, but relative to an increase of going a 0 on the front end of the yield curve to 5.25% of guaranteed return, it's like, it's hard to imagine. Let's just say it's hard to imagine Treasury securities holding up this high of yield for very long. So anyway, again, I digress. Slow business. Sorry about the ums. I'm trying to get rid of all the ums in my in my videos. So slow business. There's another one. We have a low birth rate. That's one of the primary concerns Lacey Hunt has. So the demand isn't expanding. If anything, it's going down. And when demand goes down, the economy slows down. And, low rates are expected in the future. I think low rates are coming. That's why I have 18% of my investment portfolio right now in long treasury bonds, 0Z. By the way, none of this that I say is investment advice. I just wanted to make sure that was clear here. All right. So the main point of Problems of Investment Policy, the subtitle of the introduction of this book, is the 4 problems he brings up. Is it the 4 problems of stocks? I think so. The 4 problems of investment policy. Oh, I messed that up. That's part C. So that's what the part I want to cover. So the problem of common stock investment. And there are 4 primary problems with investing in stocks. So I'll just list them straight out. Number 1, general future of corporate profits. So how much money is the company going to be able to make 10 years from now, for example? 1 year from now, 10 years from now, 20 years from now. If nobody has any babies, well, again with the interest rates. Anyway, I digress. Number 2, differential inequality of company types. I believe what he's referring to there, correct me in the comments if I'm wrong, is sort of the popularity of industries, how you can have a tulip mania. Look up tulip mania if you haven't heard of that. .com bubble, anything with the .com after it being worth so much, that's inequality of company types. People weren't buying oil companies at that time as much. And today you have companies like NVIDIA with a PE ratio of 206, while you have Star Bulk Carriers, dry bulk shipping, yielding at 1.96% of the value of its stock. So you own the stock, you get the same money that you paid for it. Not the worst deal, in my opinion. So differential inequality of company types. Yeah, dry bulk shipping isn't very popular right now, but microchips are very popular, and you have them go up and down. So let's move on. Number 3, influence of interest rates on dividends or earnings that should be demanded. So if you have a company that has no intention of growth in the future, they have exactly how many they're not going to build another one. Like, let's say it's a retailer, they're not building one more store. They're going to sit there and they're just going to keep reeling in the profits. Well, in that case, it's pretty easy to calculate if it's worth holding that company. You want a high dividend. The dividend should be higher than what you can get on a treasury yield, probably, or at least equal to, considering inflation will make that yield number grow up over time versus a treasury yield, but maybe about equal to a treasury yield, right? So, and like today we have interest rates much higher than usual, and stock values are relatively still extremely high compared to what you can get on a guaranteed return treasury right now. And the longer the treasuries offer these kind of yield, it sort of forces what you would think the value of stocks would do, which would be to go down. But this is the thing. I think interest rates will go down. So does everyone else. That's sort of what's holding up the value of stocks right now, as of today, June 4th, 2023. Let's move on. Number 4, timing versus price for buys and sells. So that's the other problem with stocks, is that when you buy it at a fair valuation, it doesn't mean, or what you consider to be a fair valuation, it doesn't mean that you're necessarily you're not guaranteed a profit. You're never guaranteed a profit. You are guaranteed the crumbs that fall off the table of the company in the form of dividends. When that happens, it's your right, but you don't have the right to sell your stock at a certain price if nobody is there to buy it. So, the timing of things is also a big problem with owning stocks, with buying stocks and selling them. Ideally, you want to obviously buy them when they're undervalued and sell them when they're overvalued. But no one knows how high overvalued something can get, and also no one knows how long something can stay undervalued for. So those are the two caveats of timing versus price. So this is the third time I've recorded this video. I hope it's shorter, more entertaining, and covers everything that I wanted to cover. I think it does. So with that, I'll see you next time with Chapter 1, Survey and Approach. Thanks for listening in. Give me a like and a subscribe below. Rob's Child.